Welcome to Supreme Court Opinions. In this episode, you'll hear the court's opinion in Bittner v. United States. In this case, the court considered this issue is a violation under the Bank Secrecy Act, the failure to file an annual report of foreign bank and financial accounts, no matter the number of foreign accounts, or is there a separate violation for each individual account that was not properly reported? The case was decided on February 28, 2023. The court held that the Bank Secrecy Act's $10,000 maximum penalty for the non-willful failure to file a compliant report accrues on a per report, not a per account basis. Justice Neil Gorsuch authored the 5-4 majority opinion holding that Bittner was subject to a fine only for each report he failed to file, not for each account he failed to report over that 5-year period. The plain language of Section 5321 addresses the legal duty to file reports, not of individual accounts or their number. The penalty the statute prescribes for non-willful violations must therefore be based on the number of reports, not on the number of accounts. In contrast, for willful violations, the statute expressly considers a penalty on a per account basis. The government's guidance as to these provisions, as well as the drafting history, further support this understanding. Justice Amy Coney Barrett authored a dissenting opinion, in which Justices Clarence Thomas, Sonia Sotomayor and Alina Kagan joined, arguing that the most natural reading of the statute establishes that each failure to report a qualifying foreign account constitutes a separate reporting violation. The opinion is presented here in its entirety but with citations omitted. If you appreciate this episode, please subscribe. Thank you. Justice Gorsuch announced the judgment of the court and delivered the opinion of the court with respect to Parts 1, 2A, 2B, and 3, and an opinion with respect to Part 2 through 100, in which Justice Jackson joins. The Bank Secrecy Act and its implementing regulations require certain individuals to file annual reports with the federal government about their foreign bank accounts. The statute imposes a maximum $10,000 penalty for non-willful violations of the law. But recently a question has arisen. Does someone who fails to file a timely or accurate annual report commit a single violation subject to a single $10,000 penalty? Or does that person commit separate violations and incur separate $10,000 penalties for each account not properly recorded within a single report? The answer makes a difference, especially for immigrants who hold accounts abroad, and Americans who make their lives outside the country. On one view, penalties accrue on a per-report basis. So, for example, a single late-filed report disclosing the existence of 10 accounts may yield a maximum fine of $10,000. On another view, penalties multiply on a per-account basis, so the same report can invite a fine of $100,000, even if the individual's foreign holdings or total net worth do not approach that amount. Because the Ninth Circuit read the law one way and the Fifth Circuit the other, we agreed to take this case. The Bank Secrecy Act, BSA, does not make it illegal to hold foreign accounts, nor does the BSA tax those accounts. To the contrary, the federal government has acknowledged that U.S. persons maintain overseas financial accounts for a variety of legitimate reasons, including convenience and access. As relevant here, the BSA simply requires those who possess foreign accounts with an aggregate balance of more than $10,000 to file an annual report on a form known as an FBR, the Report of Foreign Bank and Financial Accounts. These reports are designed to help the government trace funds that may be used for illicit purposes and identify unreported income that may be subject to taxation separately under the terms of the Internal Revenue Code. The facts of the Ninth and Fifth Circuit cases help illuminate the particular question about the BSA now before us. The first dispute involved Jane Boyd, an American citizen who held 13 relevant accounts in the United Kingdom. The amounts in those accounts increased significantly after her father died in 2009 and she deposited her inheritance. Because the aggregate amount in Ms. Boyd's accounts exceeded $10,000 in 2009, she should have filed an FBR in 2010. Neglecting to do so, she corrected the error in 2012, submitting a complete and accurate report at that time. The government acknowledged that Ms. Boyd's violation of the law was non-willful. Still, the government said it had the right to impose a $130,000 penalty, $10,000 for each of her 13 late-reported accounts. Ms. Boyd challenged the penalty in court, where she argued that her failure to file a single timely FBR subjected her to a single maximum penalty of $10,000. The district court rejected that argument and sided with the government. But in time, the Ninth Circuit vindicated Ms. Boyd's view, holding that the BSA authorizes only one non-willful penalty when an untimely but accurate FBR is filed, no matter the number of accounts. More recently, the same question arose in the Fifth Circuit in a case involving Alexandru Bittner. Born and raised in Romania, Mr. Bittner immigrated to the United States at a young age in 1982. He worked first as a dishwasher and later as a plumber, and along the way became a naturalized citizen. After the fall of communism, Mr. Bittner returned to Romania in 1990, where he launched a successful business career. Like many dual citizens, he did not appreciate that U.S. law required him to keep the government apprised of his overseas financial accounts even while he lived abroad. Shortly after returning to the United States in 2011, Mr. Bittner learned of his reporting obligations and engaged an accountant to help him prepare the required reports, covering 5 years, from 2007 through 2011. But the story did not end there. The government identified a problem in the late-filed reports. While those reports provided details about Mr. Bittner's largest account, they neglected to address 25 or more other accounts over which he had signatory authority, or in which he had a qualifying interest. After the government informed him of this deficiency, Mr. Bittner hired a new accountant who helped him file corrected FBRs for each year in question. Under governing regulations, filers with signatory authority over or a qualifying interest in fewer than 25 accounts must provide details about each account, but individuals with 25 or more accounts need only check a box and disclose the total number of accounts. Instead of employing that expediency, however, Mr. Bittner and his new accountant volunteered details for each and every one of his accounts: 61 accounts in 2007, 51 in 2008, 53 in 2009 and 2010, and 54 in 2011. The question then turned to what penalty Mr. Bittner should pay. The government did not contest the accuracy of Mr. Bittner's new filings, nor did the government suggest that his previous errors were willful. But because the government took the view that non-willful penalties apply to each account not accurately or timely reported, and because Mr. Bittner's late-filed reports for 2007 to 2011 collectively involved 272 accounts, the government thought a fine of $2.72 million was in order. Like Ms. Boyd before him, Mr. Bittner challenged his penalty in court, arguing that the BSA authorizes a maximum penalty for non-willful violations of $10,000 per report, not $10,000 per account. As he put it, an individual's failure to file 5 reports in a timely manner might invite a penalty of $50,000, but it cannot support a penalty running into the millions. The district court agreed with Mr. Bittner's reading of the law, but the Fifth Circuit upheld the government's assessment. With those facts in mind, the question before us boils down to this: does the BSA's $10,000 penalty for non-willful violations accrue on a per-report or a per-account basis? Mr. Bittner urges us to agree with the Ninth Circuit and hold that the law authorizes a single $10,000 fine for each untimely or inaccurate report. The government defends the judgment of the Fifth Circuit and asks us to hold that a new $10,000 penalty attaches to each account not timely or accurately disclosed within a report. To resolve who has the better reading of the law, we begin with the terms of the most immediately relevant statutory provisions, 31 U.S.C. Section 5314 and Section 5321. The first delineates an individual's legal duties under the BSA. The second outlines the penalties that follow for failing to discharge those duties. Section 5314 provides that the Secretary of the Treasury shall require certain persons to keep records, file reports, or keep records and file reports when they make a transaction or maintain a relation with a foreign financial agency. When it comes to the duty to file reports, the relevant duty in our case, the statute says that reports shall contain information about the identity and address of participants in a transaction or relationship, the legal capacity in which a participant is acting, and the identity of real parties in interest, along with a description of the transaction. The law also directs the Secretary to prescribe the way and the extent to which reports must be filed. Immediately, one thing becomes clear. Section 5314 does not speak of accounts or their number. The word account does not even appear. Instead, the relevant legal duty is the duty to file reports. Of course, those reports must include various kinds of information about an individual's foreign transactions or relationships. But whether a report is filed late, whether a timely report contains one mistake about the address of the participants in a transaction, or whether a report includes multiple willful errors in its description of transactions, the duty to supply a compliant report is violated. Put another way, the statutory obligation is binary. Either one files a report in the way and to the extent the Secretary prescribes, or one does not. Multiple willful errors about specific accounts in a single report may confirm a violation of Section 5314, but even a single non-willful mistake is enough to pose a problem. One way or another, Section 5314 is violated. The only distinction the law draws between these cases concerns the appropriate penalty. That's where Section 5321 comes in. As a baseline, Section 5321A5 authorizes the Secretary to impose a civil penalty of up to $10,000 for any violation of Section 5314. Here again, one thing is immediately apparent. The law still does not speak of accounts or their number. Instead, the statute pegs the quantity of non-willful penalties to the quantity of violations. And, as we have seen, Section 5314 provides that a violation occurs when an individual fails to file a report consistent with the statute's commands. So multiple deficient reports may yield multiple $10,000 penalties, and even a seemingly simple deficiency in a single report may expose an individual to a $10,000 penalty. But in all cases, penalties for non-willful violations accrue on a per report, not a per account basis. To be sure, the statute's penalty provisions do not stop there. Section 5321 goes on to say that if an individual willfully violates Section 5314, he may face a maximum penalty of $100,000. The statute then adds an even more specific rule for a subclass of willful violations: those that involve a failure to report the existence of an account or any identifying information required to be provided with respect to an account. In cases like that, the law authorizes the Secretary to impose a maximum penalty of either $100,000 or 50% of the balance in the account at the time of the violation, whichever is greater. So here, at last, the law does tailor penalties to accounts, but the statute does so only for a certain category of cases that involve willful violations, not for cases like ours that involve only non-willful violations. No surprise, the government seeks to turn this feature of the law to its advantage. Because Congress explicitly authorized per-account penalties for some willful violations, the government asks us to infer that Congress meant to do so for analogous non-willful violations as well. But, in truth, this line of reasoning cuts against the government. When Congress includes particular language in one section of a statute but omits it from a neighbor, we normally understand that difference in language to convey a difference in meaning. Expressio unius est exclusio alterius. The government's interpretation defies this traditional rule of statutory construction. The government's problem repeats itself too. Section 5321A, 5b2, contains a reasonable cause exception. That exception allows an individual to escape a penalty, say for filing late, only if his violation was non-willful due to reasonable cause, and the report he eventually files accurately reflects each and every account. All of which supplies further evidence that, when Congress wished to tie sanctions to account-level information, it knew exactly how to do so. Congress said that penalties for certain willful violations may be measured on a per-account basis. Congress said that a person may invoke the reasonable cause exception only on a showing of per-account accuracy. But the one thing Congress did not say is that the government may impose non-willful penalties on a per-account basis. Conspicuously, the one place in the statute where the government needs per-account language to appear is the one place it does not. In the end, the government's per-account theory faces not just a single expressio unius challenge but two. The dissent founders on the same shoals. It suggests that the pattern of account-specific language in the willful penalty provision and the reasonable cause exception connotes that the non-willful penalty provision must operate on a per-account basis. But, again, just because two provisions in the law are similar does not mean we may ignore differences found in a third. Seeking a way around the problem, the dissent points to the fact that even a single qualifying foreign bank account triggers the duty to file a report, and the fact that a compliant report must contain a list of information about bank addresses and the like. These features of the law, the dissent says, underscore that non-willful violations accrue per account, but that simply does not follow. The fact that a person has a duty to file a report, or provide certain information in a report, does not tell us whether penalties for non-willful violations accrue per report, or multiply per account without regard to an individual's net worth or foreign holdings. Widening our view beyond Section 5314 and Section 5321, we find other contextual clues pressing against the government's theory. Consider what the government itself has told the public about the BSA. In 2010, the Department of the Treasury issued a notice of proposed rulemaking warning that, under its proposed rules, a person who is required to file an FBR and fails to properly file may be subject to a civil penalty not to exceed $10,000. Elsewhere, the government has told suspected FBAR violators that for the failure to file, the penalty cannot exceed $10,000. Instructions included with the FBR form have cautioned that a person who is required to file an FBR and fails to properly file may be subject to a civil penalty not to exceed $10,000. An IRS fact sheet has advised that, for the FBR, the penalty may be up to $10,000 if the failure to file is non-willful. Ms. Boyd herself received a similarly worded letter alerting her that for the failure to file the FBR, the penalty cannot exceed $10,000. None of these representations about the law's operation fits easily with the government's current theory. In all of these warnings, fact sheets, and instructions, the government seemed to tell the public that the failure to file a report represents a single violation exposing a non-willful violator to one $10,000 penalty. Nowhere in these materials did the government announce its current theory that a single deficient or untimely report can give rise to multiple violations, that the number of non-willful penalties may turn on the number of accounts, or that the $10,000 maximum penalty may be multiplied 272 times or more, without respect to an individual's foreign holdings or net worth. Doubtless, the government's guidance documents do not control our analysis and cannot displace our independent obligation to interpret the law. But this court has long said that courts may consider the consistency of an agency's views when we weigh the persuasiveness of any interpretation it proffers in court. Here, the government has repeatedly issued guidance to the public at odds with the interpretation it now asks us to adopt. And surely that counts as one more reason yet to question whether its current position represents the best view of the law. The drafting history of the non-willful penalty provision undermines the government's theory too. When Congress adopted the BSA in 1970, the law included penalties only for willful violations and capped them at $1,000. It took many years before Congress in 1986 authorized the government to impose penalties on a per-account basis for certain willful violations, and it took many years more before Congress in 2004 amended the law again to authorize penalties for non-willful violations. When crafting this latest provision, it would have been the simplest thing for Congress to model its work on its 1986 amendment and authorize per-account penalties for non-willful violations, just as it had for certain willful ones. But Congress didn't do anything like that. The language it adopted for non-willful penalties in 2004 bears scant resemblance to the language it used when authorizing per-account penalties for certain willful violations in 1986. Consider as well Congress's statement of purpose. Congress has declared that the BSA's purpose is to require certain reports or records that may assist the government in everything from criminal and tax to intelligence and counterintelligence investigations. Here we see further evidence that the relevant legal duty the BSA establishes is the duty to file certain reports. We see evidence too that the point of these reports is to supply the government with information potentially relevant to various kinds of investigations, criminal and civil alike. But what we do not see is any indication that Congress sought to maximize penalties for every non-willful mistake, whether a late filing, a transposed account number, or an out-of-date bank address. The Secretary's regulations implementing the BSA convey the same message. Under those regulations, individuals with fewer than 25 accounts must provide details about each account, while those, like Mr. Bittner, with 25 or more accounts do not need to list each one or provide account-specific details about any of them. Instead, filers with 25 or more accounts need only provide the number of financial accounts and certain other basic information. Naturally, an individual must supply more detailed information if the Secretary or his delegate later chooses to follow up and request it. But no detailed account-level information is required in the filer's initial report. It's yet another feature of the BSA and its regulatory scheme that suggests the law aims to provide the government with a report sufficient to tip it to the need for further investigation, not to ensure the presentation of every detail or maximize revenue for each mistake. The Secretary's regulation also points to some of the anomalies that accompany the government's per-account theory. On the government's telling, an individual with, say, 3 accounts who makes non-willful errors when providing details about these accounts faces a potential penalty of $30,000. He faces that penalty no matter how slight his errors, and regardless whether his foreign holdings or even net worth approach the same amount. Meanwhile, a person with 300 bank accounts runs far less risk of incurring any penalty. He doesn't have to provide any detail about his accounts, just correctly disclose how many he holds. Nor is this the only incongruity the government's theory invites. Consider someone who has a $10 million balance in a single account who non-willfully fails to report that account. Everyone agrees he is subject to a single penalty of $10,000. Yet under the government's theory, another person engaging in the same non-willful conduct with respect to a dozen foreign accounts with an aggregate balance of $10,001 would be subject to a penalty of $120,000. On the government's view too, those who willfully violate the law may face lower penalties than those who violate the law non-willfully. For example, an individual who holds $1 million in a foreign account during the course of a year but withdraws it before the filing deadline, and then willfully fails to file an FBR faces a maximum penalty of $100,000. But a person who errs non-willfully in listing 20 accounts with an aggregate balance of $50,000 can face a penalty of up to $200,000. Reading the law to apply non-willful penalties per report invites none of these curiosities. The government's per-account theory invites them all. The government does not dispute any of this, but replies that the per-report interpretation risks an anomaly of its own. After all, the government observes, the BSA affords the Secretary considerable discretion in formulating reporting requirements. So much so, the government contends that the Secretary could require a separate report for each account, and in that way effectively achieve a per-account penalty for non-willful violations. But what does this prove? Assuming the Secretary could require more frequent reports, a question not before us, that would mean the Secretary could also require less frequent reports, for example, every other year. Likewise, the Secretary could reduce the amount of information required in those reports, say, expanding the tick box option to all filers, not just those with 25 or more accounts. Perhaps more fundamentally, whether the Secretary may lawfully ordain more or fewer reports does nothing to answer the question whether the Secretary may impose non-willful penalties on a per-report or per-account basis. That question would still remain. To the extent doubt persists at this point about the best reading of the BSA, a venerable principle supplies a way to resolve it. Under the rule of lenity, this court has long held, statutes imposing penalties are to be construed strictly against the government and in favor of individuals. Following that rule here requires us to favor a per-report approach that would restrain BSA penalties over a per-account theory that would greatly enhance them. The government resists this conclusion by seeking to distinguish Acker. That case involved a penalty provision in the Internal Revenue Code, the government emphasizes, while this case involves a penalty provision in the BSA. But that distinction makes no difference. The rule of lenity is not shackled to the Internal Revenue Code or any other chapter of federal statutory law. Instead, as Acker acknowledged, the law is settled that penal statutes are to be construed strictly, and an individual is not to be subjected to a penalty unless the words of the statute plainly impose it. Notably, too, Acker cited to and relied on cases applying this same principle to penalty provisions under a wide array of statutes, including the Communications Act of 1934, a bankruptcy law, and the National Banking Act. Two additional features of this case make it a particularly appropriate candidate for the rule of lenity. First, the rule exists in part to protect the Due Process Clause's promise that a fair warning should be given to the world in language that the common world will understand, of what the law intends to do if a certain line is passed, and the government's current theory poses a serious fair notice problem. The relevant provisions of the BSA nowhere discuss per-account penalties for non-willful violations. A number of the government's own public guidance documents have seemingly warned of per-report, not per-account, penalties for non-willful violations. We are even told that until 2008 and 2009, when the government began aggressively enforcing FBR penalties, many experienced tax professionals and return preparers were not aware of the FBR reporting obligations, let alone aware of the government's current theory about the scope of penalties for non-willful violations. If many experienced accountants were unable to anticipate the government's current theory, we do not see how the common world had fair notice of it. Second, the question before us has criminal as well as civil ramifications. Section 5321 outlines civil penalties for non-willful and willful violations of the BSA. Next door, Section 5322 provides criminal sanctions for willfully violating the Act. The term violation or violating is a constant between these two provisions. Accordingly, if the government were right that violations accrue on a per-account rather than a per-report basis under Section 5321, the same rule would apply under Section 5322. Each willfully misstated or late reported account, rather than each deficient or late filed report, would give rise to a separate criminal violation carrying the possibility of a $250,000 fine and 5 years in prison. In a case like Mr. Bittner's, involving 5 reports and 272 accounts, that would mean a person who willfully violates that BSA could face a $68 million fine and 1,360 years in prison, rather than a $1.25 million fine and 25 years in prison. In these circumstances, the rule of lenity, not to mention a dose of common sense, favors a strict construction. Best read. The BSA treats the failure to file a legally compliant report as one violation carrying a maximum penalty of $10,000, not a cascade of such penalties calculated on a per-account basis. Because the Fifth Circuit thought otherwise, we reverse its judgment and remand the case for further proceedings consistent with this opinion. So ordered. Justice Barrett, with whom Justice Thomas, Justice Sotomayor, and Justice Kagan join, dissenting. Alexandru Bittner, an American citizen, held as much as $16 million across more than 50 bank accounts in Romania, Switzerland, and Liechtenstein. He acknowledges that the Bank Secrecy Act, BSA, and its implementing regulations required him to report his interest in these accounts to the federal government annually. Bittner also admits that he failed to comply with that requirement for 5 consecutive years. Because he failed to report 272 accounts, the government concluded that he violated the law 272 times and assessed a penalty for each violation. Bittner, on the other hand, argued that he violated the law just 5 times, once for each annual form that he failed to file. The court agrees with Bittner and holds that the failure to file a legally compliant form is a single violation, no matter how many accounts a citizen fails to report. I respectfully disagree. The most natural reading of the statute establishes that each failure to report a qualifying foreign account constitutes a separate reporting violation, so the government can levy penalties on a per-account basis. This case requires us to decide whether a violation of the BSA's reporting requirement is the failure to file an annual form, or whether there is a separate violation for each individual account that is not properly reported. The answer lies in the text of the relevant statutes, 31 U.S.C. sections 5314 and 5321. The government assessed penalties against Bittner under section 5321A, 5A, which provides that the Secretary of the Treasury may impose a civil money penalty on any person who violates, or causes any violation of, any provision of section 5314. Section 5314, in turn, directs the Secretary to require a citizen of the United States to keep records, file reports, or keep records and file reports when the person makes a transaction or maintains a relation for any person with a foreign financial agency. Section 5314A. The required records and reports shall contain certain information in the way and to the extent the Secretary prescribes, such as the identity, address, and legal capacity of the participants in a transaction or relationship. The text of Section 5314 indicates that its reporting requirement attaches to each individual account. Most notably, it provides that the Secretary shall require a citizen to file reports when he maintains a relation with a foreign financial agency. The subject matter of the required reports, then, is a relation with a foreign financial agency, or more colloquially, an account with a foreign bank. In other words, each relation with a foreign bank triggers the requirement to file reports. And because each relation is a matter of distinct concern under the statute, each failure to report an account violates the reporting requirement. The enumerated list of information that the report shall contain blanks the point. That list includes information like the identity and address of participants in a relationship, the legal capacity in which a participant in a relationship is acting, and the identity of real parties in interest. Sections 5314A, 1-3. Each listed item is account-specific because its contents can vary for each foreign account held, and each failure to report an account thus deprives the government of the account-specific information that the statute requires. That is not all. Section 5314 authorizes the Secretary to impose a record-keeping requirement in addition to a reporting requirement. Record-keeping violations cannot occur on a per-form basis, because keeping records does not entail filing a form. Instead, they occur on a per-account basis because records naturally relate to specific accounts. And if violations of Section 5314's record-keeping obligation accrue on a per-account basis, the same should be true of violations of Section 5314's obligation to file reports. The duties are parallel. Each kicks in when a citizen maintains a relation with a foreign financial agency, and each requires a person to collect the same account-specific information. Section 5314A. Parallel duties should be susceptible to parallel violations. The civil penalty provisions in Section 5321 confirm this reading of the substantive obligations imposed by Section 5314. Recall that Section 5321 allows the Secretary to impose a civil money penalty on any person who violates, or causes any violation of, any provision of Section 5314. The statute then proceeds to set the maximum penalty for non-willful violations, provide a reasonable cause exception for those same violations, and set the maximum penalty for willful violations. Throughout, Congress used the term violation in an account-specific way. Consider the reasonable cause exception. It provides that no penalty shall be imposed, with respect to any non-willful violation of Section 5314 if, 1. such violation was due to reasonable cause, and 2. the balance in the account at the time of the transaction was properly reported. By conditioning eligibility for the excuse on taking steps to report accurate information about a particular account, this language suggests that the underlying violation of Section 5314 is similarly tied to a specific account. After all, if the exception for non-willful violations applies on a per-account basis, then logically the violations the exception forgives must arise on a per-account basis too. The willful penalty provisions sing the same tune. The maximum penalty for a willful violation is the greater of $100,000 or, in the case of a violation involving a failure to report the existence of an account or any identifying information required to be provided with respect to an account, 50% of the balance in the account at the time of the violation. This language makes clear that a violation may involve a failure to report the existence of a particular account. By making the maximum penalty for a willful violation, in some cases, a function of the balance in the account at the time of the violation, the provision contemplates that discrete violations correspond to discrete accounts. This pattern matters. The The normal rule of statutory interpretation is that identical words used in different parts of the same statute are generally presumed to have the same meaning. If a violation of Section 5314 has account-specific connotations in the reasonable cause and willful penalty provisions, it follows that a violation of Section 5314 has account-specific connotations when it comes to non-willful penalties too. The Secretary's implementing regulations follow the BSA's lead. They require regulated persons to report the existence of each foreign financial account to the government each year. Start with 31 CFR, Section 10.350, 2011. It says that each United States person having a financial interest in a bank, securities, or other financial account in a foreign country shall report such relationship to the Commissioner of Internal Revenue for each year in which such relationship exists, and shall provide such information as shall be specified in a reporting form prescribed under 31 U.S.C. 5314 to be filed by such persons. The reporting form is known as an FBR, a report of foreign bank and financial accounts. A separate regulation establishes the deadline for reporting these relationships. Reports required? To be filed by Section 10.350 shall be filed by June 30th of each calendar year, with respect to foreign financial accounts exceeding $10,000 maintained during the previous calendar year. Put together, these provisions impose a substantive obligation to report interests in foreign bank accounts each year in which those interests exist. Notably, the regulations distinguish between the form used to report accounts and the reports themselves. This underscores that FBR forms are not themselves the reports required by the statute. Rather, they are the procedural mechanism used to implement the duty to report each foreign account. This distinction tracks Section 5314, which emphasizes a citizen's duty to file reports but nowhere mentions FBRs, or for that matter, forms of any sort. Section 5314A. So far as Section 5314 is concerned, the Secretary could have chosen a different mechanism to implement the statute. For instance, rather than instructing citizens to report all accounts on a single form, he could have instructed citizens to report each account on a separate form. And if the Secretary had taken that route, Bittner would be hard-pressed to deny that he would have violated the statute 272 times by failing to file 272 forms. That difficulty illustrates Bittner's fundamental misunderstanding of the account-specific obligation imposed by Section 5314, which is indifferent to the mechanism by which the obligation is discharged. In the end, the applicable statute and regulations make clear that any failure to report a foreign account is an independent violation, subject to independent penalties. Bittner violated the law 272 times when he failed to report 272 accounts over 5 years, and the government is entitled to impose a penalty for each violation. The court resists the most natural reading of the text. It reasons that Congress has authorized the Secretary to impose penalties for non-willful violations on a per report, not a per account basis. The court also invokes the rule of lenity to resolve any lingering ambiguity in Bittner's favor. I respectfully disagree. The court sees the statute differently. In its view, a violation of Section 5314's reporting requirement occurs when an individual fails to file a report consistent with the statute's commands, and the BSA, it continues, does not speak of accounts or their number when it discusses penalties. It says that the Secretary of the Treasury may impose a civil money penalty on any person who violates any provision of Section 5314. The statute thus authorizes the government to impose a single penalty for a single violation of the requirement to file reports, no matter how many accounts are not properly reported. This interpretation defies the most natural reading of the text. Section 5314 does not, as the court says, establish a discrete reporting requirement untethered to the subject matter of the required reports. It establishes a duty to file reports when a citizen makes a transaction or maintains a relation with a foreign financial agency. That duty is naturally parsed in relation or account-specific terms, and any doubt that the duty is account-specific is eliminated by the reasonable cause exception, which contemplates that violations are tied to the failure to report individual accounts. So while Section 5321 does authorize a single penalty for a single violation of the reporting requirement, each failure to report an account is a discrete violation of the reporting requirement that triggers a separate penalty. To illustrate the point, imagine a reporting statute that required citizens to disclose their interests in real property each year, and specified that the required reports shall contain information like the location of the property and the identity of the owner. The court's logic would treat the duty to disclose interests in multiple properties as a single reporting obligation subject to a single violation. But common sense suggests that the duty would require citizens to report each property in which they hold an interest, and a failure to report each property would be a separate violation. Just so here, the duty to file reports for accounts maintained at foreign banks entails reporting each foreign account, and a failure to do so for each account is a separate violation. The court has no satisfactory answer to this common-sense reading of the text. The best it can do is point to 31 U.S.C. Section 5314c(1). That provision allows the Secretary to prescribe not only the content of required reports, but also their form. The court argues that this provision makes the duty to report an account's unspecific obligation to file a form. But nothing in Section 5314c(1) indicates that the Secretary's discretion to design the form of the reports has any bearing on whether a failure to file reports on an account-by-account basis constitutes a violation. In fact, Section 5314c(1) applies with equal force to the parallel record-keeping obligation in Section 5314a, but the court wisely does not argue that record-keeping violations accrue on a per-form basis. By authorizing the Secretary to design the form used to implement the duty to file reports, Congress did not alter the substance of the underlying duty or the account-specific nature of a violation of that duty. To justify its interpretation, the court invokes the consequences that might follow from treating violations as accruing on a per-account basis. It worries that individuals who fail to report dozens of accounts may be subject to substantial penalties that approach the maximum aggregate penalty for willful violations. But Congress's decision to impose different penalties on those who willfully and non-willfully fail to report their accounts should be respected. It is not this court's job to second-guess Congress's judgments by superimposing our own policy preferences on the statutory text, nor is there much reason to fret about these consequences in the first place. The statute caps the maximum penalty for a non-willful violation at $10,000, Section 5321a, 5bi, and it gives the Secretary discretion to determine the amount of the penalty below that ceiling, Section 5321a, 5a. Nothing requires the Secretary to impose the maximum penalty for each account, and the reasonable cause exception provides an added layer of protection for inadvertent violators. Section 5321a, 5b2. To the extent the court's real concern is overzealous enforcement by the government, our precedents offer remedies. The rule of lenity does not help Bittner either. The rule of lenity is a tie-breaking principle that applies only when, after employing all the tools of statutory interpretation, a court can make no more than a guess as to what Congress intended. Courts have a duty to construe statutes, not to invalidate them out of hand, and the rule of lenity applies only if, after seizing everything from which aid can be derived, a court can make no more than a guess as to what Congress intended. Thus, before resorting to the rule of lenity, a court must exhaust all the traditional tools of construction. Only if there remains a grievous ambiguity or uncertainty should a court apply the rule of lenity and interpret the statute in the defendant's favor. There is no grievous ambiguity here. As I have explained, the most natural reading of the statute establishes that a failure to report an account constitutes a violation of the law, so the rule of lenity does not come into play. Even if the majority's interpretation were plausible, another provision of the BSA, 31 U.S.C. Section 5321a, 5b2 would settle this case. Section 5321a, 5b2 establishes a reasonable cause exception for non-willful violations, providing that no penalty shall be imposed, with respect to any violation of Section 5314 that was due to reasonable cause, and that was accompanied by a properly reported balance in the account at the time of the transaction. By conditioning eligibility for the exception on the proper reporting of the account, this provision makes clear that a violation of Section 5314 is the failure to report an account. The court dismisses Section 5321a, 5b2 as irrelevant because, in its view, the violation referenced in that provision is the failure to file an FBR, and the reference to an account specifies how to qualify for the reasonable cause exception. I do not see how the court's interpretation of the reasonable cause exception supports its conclusion that violations accrue on a per-report basis, and more importantly, the court's interpretation reads the reference to the account out of the statute. If the violation referenced in Section 5321a, 5b2 were a violation of the duty to file an annual form, there would be no reason to reference the reporting of an individual account to determine whether the exception is met. The court tries to deal with Section 5321a, 5b2 by invoking the canon against superfluity. It argues that interpreting the statute to impose a penalty on a per-account basis would render Section 5321a, 5b2 superfluous. But the court's canon against superfluity argument gets things backward. The point of the canon is to avoid rendering any statutory provision superfluous, but interpreting violations of the reporting requirement to accrue on a per-report basis would render the reference to an account in Section 5321a, 5b2 superfluous. Congress could have simply said that no penalty shall be imposed with respect to any non-willful violation, if that violation was due to reasonable cause, and the form was otherwise properly filed. The fact that it did not is a textual clue that a violation of the reporting requirement is account-specific. By contrast, interpreting Section 5321a, 5b2, To establish that a violation of the duty to file reports is the failure to report an account gives effect to every word in the statute, and it does so in a way that is consistent with the other clues that the text provides. The most natural reading of the text establishes that Bittner violated the law 272 times when he failed to report 272 accounts over 5 years. I would reverse the judgment of the Court of Appeals. I respectfully dissent.